What is financial freedom?
Having the freedom to choose the life that you really want without having to have the financial constraints. You need to have investments and you need to have at least assets.
What's the difference between investments and savings?
It's a very thin line.
What are some of the things that you've seen in the market that people think are investments but are actually just savings?
Money matters are not taught in school. The peer pressure is real. They're really pushing that idea of if you don't have this, you're actually not living your soft life or you're not even having a life. You see the hype around iPhone 17. We might end up retiring the most poor generation. There are two ways you earn money, in stocks or in shares. The first one is capital gains, and then now we have the dividends. Because I'm a shareholder, I'm entitled to share into the profits.
Uko karibu kukuza mlima.
Some people need to stop running those businesses and go look for a job.
Yes. Oh my goodness, have mercy on us. Because most of us, the people who are in employment are way better. Ladies and gentlemen, my name is Daddy Blessing. Welcome to the EE PowerTalk episode 103. And like I have previously said, there are some things that we have been talking about in this podcast, and most of them have been theory per se. And we want to bring on board experts who can speak on things that we have been talking about, because at times we fail to input the information because on our end we are not experts. And today we are talking about a critical matter, which is wealth building and anything that concerns money. Mimi nayo tunakuaga hivi. That's why I don't talk about it, because there are so many things that are happening in the modern world, especially in this new age and era of personal finance and all those things. Everyone is an expert right now, especially if they are trying to onboard you to something and all that. So I try not to be one of those people, and I let the experts do their nini. And in regard to that long and short introduction, I have a very good friend of mine who is going to take us through the process of wealth building. Her name is Jane. You can introduce yourself. That's your camera. You can tell people who you are and what you do.
Hi, Daddy Blessing.
Hi.
How are you?
I'm very fine.
I'm so excited to be here. I had to say that in the introduction, first of all.
Yeah.
And thank you so much for having me here.
Yeah.
So my name is Jane Ndichu, and I'm a financial advisor. I'm based in Kenya. So what I basically do, I help people with their money, making sure that your money is doing what you want it to do for you. And you're actually able to achieve financial freedom, and you're able to actually to get where you have always wanted to get in this life.
Yes.
Yes.
Now, you've mentioned financial freedom. What is financial freedom?
Financial freedom is basically having not to worry and having options of what you want your life to look like. Like you don't have to actively work, but you're making an income, or you don't have to forego some few things because you cannot be able to afford them. So it's basically an idea of having options or having the freedom to choose the life that you really want without having to have the financial constraints.
So now, how does one get there?
So these steps, it has 7 levels actually. So there are different levels into financial freedom. So that means that you, in your initial stages, you're really trying to understand your habits. I think the first level is actually, first of all, getting an income, making sure that you have an income. The second level is where now you're trying to balance in between budgeting, learning how you're supposed to allocate your money. And then the other step is when you have started setting aside some money to go to your emergency fund. So knowing that I can comfortably be able to survive within an emergency or something close to that. And then the other level is where you're able now to have options around investments. So this is where you're looking at passive income. And then now the other level is where you have accumulated the wealth. You're trying to protect the wealth and multiply the wealth. And the last stage is now the financial independence. This is where most people don't get, because this is the extreme level of wealth. These are people now who are not even looking at the numbers. They are looking at the legacies. They are looking at, I'm the richest person in Africa. I'm the richest person in the world. So there are levels into it. So it's basically you understanding which level you're in and now trying to grow that and knowing that this is the strategy. This is where I want to be next year or the other year or the other year. And this is the plan that I'm going to use. Yeah.
You've mentioned wealth also, and I would love to know, does it have a common definition, or wealth is purely determined by the context of the person? Maybe what I might interpret as wealth, it cannot be wealth for someone else. Does wealth really have a universal definition?
I wouldn't say it has like a universal definition when it comes now to the basics of individuals, because we have different aspects of, for me, I'm wealthy when I have this. For you, you're wealthy when you have this. But we have the baseline. Like, you cannot be wealthy if you don't have assets. There's no way you're going to tell us you're wealthy if you don't have investments. So there's the baseline. Now, I think the levels of who is wealthy, or the levels of am I wealthy when I have maybe this amount of money, now that's purely determined by a person and what they believe in. But there's now the common rule of you need to have investments and you need to have at least assets for you to be considered a wealthy person. Yeah.
So what's the difference between investments and savings?
So the difference is it's a very thin line. So savings is like putting money aside for you to spend later. So can be tomorrow, can be in a year, in 2 years. And then investment is putting money aside for you to spend tomorrow, but the money is actually giving you more money. So you're getting a return on investment. So basically savings, your money will just sit there. It is not earning you anything. Like just putting money under your mattress, that's saving. Now investment is purely you're putting your money into an investment portfolio or an investment vehicle, and then now that money is growing you an interest. So that's the difference between the two. Yeah.
What are some of the things that you've seen in the market that people think are investments but are actually just savings?
Wow, that's actually direct to the point. I think mostly mobile banking. So like, for example, when you're saving your money in a bank, that's not an investment. Or maybe when you're putting your money in a Mshwari, that's not an investment. Or your M-Pesa, that's not an investment. Chamas, the merry-go-round chamas where there's no table banking, there's no investments involved, that's not actually investment. So I think those are the few that I think most people think it's an investment and it's not. Yeah.
So now, when it comes to wealth building and all that, there is this new conversation of how to invest even in digital assets and all that. But before we get there, there are some traditional ways of building wealth. As a person who is a financial advisor, what are some of the things that you would say now, these are the steps that you take traditionally to generate wealth?
Okay, I think I wouldn't like to say like we just adopt it blindly, like what was being used to now. But I think there are basics that need to be there or incorporated in your journey or in your wealth creation journey, like the basics of home ownership. If maybe you're a person who is looking into having a family, it's a basic thing to have. It's a need. It's something that you need to have. So I think most of the people in the traditional way, they used to really invest so much into land, buying land, or in the real estate, which is these days it's more modernized. I think you can still do real estate, but it's more modernized. And I think it was basis of those were the options that were there. And I think the other thing that was there is more of running a business, and then it used to be farming or something close to that. I think those are the business model, but I think you can be able to pick into the traditional ways of investment, but now choose it on a more modernized model. Like if I'm doing real estate, I don't have to just own an apartment like this, or I don't have to own a piece of land. I can actually do that through a fund manager or maybe an investment broker and get rates or something close to that, do Airbnbs. I mean, it's more like there are those that we can still stick with, but now at least try to adjust more, because I'm more like a passive investor kind of a person.
Okay.
I really know that is the way, and I think it's a very thin line in between telling people you don't need 10 pieces of land and them just sitting there. But I think there's modern way if you still feel like, for me, having the piece of land is the only investment that I believe in. They are more modernized way. Yeah.
As a financial advisor, do you think you guys are experiencing a bit of a rough time trying to tell people there are new ways of investing and they are used to old ways that they've seen work?
Yeah, yeah, it's there. It's actually there. And I think that's why we have a community that is somehow not financially empowered, for lack of a better word, or maybe the financial literacy is not well it's not getting the maybe the uptake that it deserves. But I feel it's even in the previous days. I think you have heard of stories where people say, where was my grandparent when other grandparents were buying pieces of land in Kayole, in Nairobi? So I think this is not something everyone will experience because it requires a lot of discipline, and so many of us really struggle with that. So it's a challenge, and I feel like this is why we are doing what we are doing, to just make sure that it gets to the right people and the right people take action. But I think that's the way to go. We cannot keep doing the old way and just doing things for other people and not for ourselves. Yeah.
When it comes to creating wealth, does your initial introduction to money, let's say how you have grown seeing money being handled and all that, does it affect how you get into creating wealth?
Yeah, and it's such a big thing that most people don't realize, that we have carried a lot of trauma from where we are coming from. And most of the time, your relationship with money, it comes from a mindset that you saw and learned. Remember, money was not taught in school. And most of the mindset or the things that we learned with our parents were changed when we went to school. Like if you grew in a family where they did not have maybe, for example, they did not know about maybe even languages, eloquence, basics of that, you're able to learn that in school and just know more about it. If you grew in a family where they only had conversation, you can only become a teacher, police, and such thing because that's what your uncle was. When you went to school, you just realize, okay, kumbe there is neurosurgeon or something close to that. So I feel like the fact that money matters are not taught in school, most of us skipped that stage of actually fighting and changing our mindset around money. And that is what is affecting most people. Because I think every day I wake up and I'm doing a consultation session, everyone is always telling me, my other goal is buy a piece of land. That's the next thing they do. My other goal is build my mother a home. My other goal is do this to maybe my brother. It's because they grew in a place, maybe they were not financially supported, or they grew in a place where they did not get the best of shelter, and now they feel up to them to change that situation. So I feel that really has affected so many people. But I think it's something that you can actually change and learn or unlearn, and you can be able to work around. So yes.
So now, is the culture of consumerism affecting investing?
Yes. I think with the rise of every day you wake up, swipe your TikTok, your Instagram, your WhatsApp, it's basically even in WhatsApp group, someone is just advertising a new walking pad. They're advertising a new sound bar. They're advertising this new joint. And I feel like it's more glorified. And this is something like I feel this is one of the reasons why this generation might be the poorest. We might end up retiring the most poor generation because we have really glorified that. You see the hype around iPhone 17.
Yes.
Compare that to the hype of an investment like special fund, which is actually getting its root right now. Compare the hype. It's just a drop in the ocean, you know? So I feel, it's actually affecting so many people because the peer pressure is real, and the influence, and I think even the commercials, they're really pushing that idea of if you don't have this, you're actually not living your soft life, or you're not even having a life. So I feel it affects a lot of people in multiples of even making bad financial decisions. Yeah.
There are some purchases we make and label them investments. Have you come across such a thing?
Yes.
When a person has purchased a thing, and to them, and clearly they can explain how that is an investment, but you clearly can see how...
like a phone or even your car, and you work in an 8 to 5. Your car is always parked in the basement, and you basically cannot even afford the basics of life, but you have a car and you say it's an investment. In Nairobi, you need a car. But it's a mode of transport. You have other options which are comfortable and you can be able to run with. There's so many things we can actually mention that people do and they're like, this is an investment. But in real sense, these are assets that are reducing in value. in real sense, these are assets that actually require you to input money, or maybe like if it's a car or something close to that. And I feel it's more like what we just talked about, the whole influence around, I don't want the FOMO, I just want to belong, So there's so many of them. And I think that concept has led so many people not able to not able to get to a financial freedom phase, or even never understand what financial freedom. So it's a race of more money, you're in debt, and so many other things. Yeah.
Hiya. I'm a new graduate, getting my first salary, settling and all that. Now I have, after spending, I have like 5,000 remaining and all that. I have never heard of the word investing. How do you, or what is the simplest way of explaining what investing is to a person like me?
The simplest way would be like a way of paying yourself, or a way of being able to give yourself freedom, or setting aside money that will only come back to you, because the rest of the money will never come back to you. And I think to such a person, I'm going directly to financial goals. What do you want your money to do for you? Like, what do you want? Then they will go to the basics of, I want a car, I want a house, I want to retire before 50 years, I want this. So when they present the 5,000, I'll tell them, you see, in the initial stages, the investment that we're going to do this is savings and investment, because we set aside this money for this particular reason, to achieve your financial goals. So I'm basically going to show them the freedom that they're going to get at the end of the day, and also showing them that your money is actually working for you, and it's going to come back to you in the future in one way or the other, by maybe achieving whatever you want. So that, I think that's the best way I would want to imagine I would explain to you. It's just touching the future, or planning for that life that you really want, or achieving the things that you're really looking at. Yeah.
Again, being a scholar and someone who is now being introduced to life and all that, probably if I'm fascinated about wealth, I have studied people who invest. And investing to me means investing in large numbers and millions and all that. So where do I fit with my 5,000?
Oh, now the first category might be accumulation. The first thing that you might need to do is accumulation. Yes. So at this particular point, you're looking at a place where you'll be offered the options of, I can save, or I can put or build into it. Then once maybe you have accumulated your 5,000, at the end of the year, you have your 60,000, then we can now consider, do we move this money to now a pure investment, like maybe government securities or shares or such portfolios. But the basics is more like, we might need a savings and investment account. Those are the likes of money market fund, or maybe fixed funds, which might require the minimum of 5,000 Kenya shillings. So there's options for each and every class of a person. And I always tell people, you cannot invest everywhere. You cannot be everywhere. So you need to identify what works for your financial goals, and which instruments or savings and investments you can use, and then you run with that. I think and there's minimum investments in most of these savings and investments. We have even 2,000, 1,000, some 500. So 5,000 is just a good entry level.
Now, the environment that we are in, you've mentioned two things that are really catching up the hype, shares and money market. Now, everyone is talking about money market and how it's a way of investing. Like you've said, it's along the same lines, but you've classified it as savings. How does money market fund work exactly?
So a money market fund, just going to the basics, the simplest way I would say it, it's more like having a bank account. And then this bank account, or a current account, they call it a current account. This current account, you can be able to put in your money, and you can be able to withdraw your money.
Yes.
But now the difference between your bank and your money market fund is, this money market fund is compounding your interest. Compounding means, if today I put my 10 bob, and it earns an interest of 1%, that means by the end of maybe that month, I have like 0.1 Kenya shillings, which is added to my interest. If I don't withdraw that money, the following month, the 10.1 Kenya shillings is going to earn me another interest. Okay,
or it will be the principal.
Exactly, it will be the principal. So it's the easiest way to actually compound your money. So it's more like you have the freedom and the flexibility to access your money, and there's no much of the risk. It's considered as a low risk investment because the fund manager, who are now the institutions that you're going to choose to manage your money, they choose investments that are low risk, and most of them are government securities, like the treasury bills and commercial papers. These are like borrowing to the local market or banks or institutions. So in most of the cases, they will never default, and your capital is preserved. So it's not being traded at no particular point. So I think that is the easiest way I would explain our money market. But it's not an investment. It's more of a savings and investments. It makes sense when you have a lot of money in it. And it also makes sense when you use it for accumulation or holding, as you try to look for other investments which can be able to outperform whatever you're getting in the money market. Yes.
Now let's talk about shares. How do they work?
Okay, so stocks or shares, or what we call shares. So you basically like trying to buy a part of the company. So I want maybe to be a shareholder in the EE Talk. So I come to you and I tell you, I have 100,000 I want to give you. So how much will that be worth?
Yes.
A certain share of that company. So what it means, you'll find like shares have prices. So meaning if EE Talk is worth maybe, let's say, 1 million, if you divide to all of it, if it's worth 1 million, if I was to take or to invest 100,000, that means I'm taking 1% of that. 10% of that investment. If I do 10,000, that means I'm taking around 1%.
Yes.
So that's what they do. So Safaricom has the whole entity, and they know their value, their asset base. And then now, when they're saying that our share price is 27 per share, that means they have done the basics of that. So if I'm investing in Safaricom and the minimum shares is 1,000 shares, I'm going to, the price is 27. So it's 27 times 1,000. So that's the money that I'm going to invest in shares. And then there are two ways you earn money: in stocks or in shares. The first one is capital gains, like whatever happened when we have, I think it when Bob Collymore died, the shares went down, and then they shoot up when, what is his name? I've forgotten. No, the chairman. What is
Michael
his
Joseph?
name? Yes, when Michael Joseph came into place, the shares went up. So if I bought when they were down there, my capital is going to gain some amount of money. And then now we have the dividends. Because I'm a shareholder, I'm entitled to share into the profit. So if the company makes a profit, they're going to divide according to my share. So I'm going to get some dividends. But it's somehow a risky investment. It's among medium, high risk, depending on the company you choose, because one small mistake,
company can declare bankruptcy and
you can lose your money. So it needs someone who can be on toes with what the company, how the company is running, knows when to buy, to sell. Because we have so many people who do like some few businesses here and there. I'm not going to mention here to make more money in stocks. But there's so many ways of doing that. But for entry levels, just go for the companies that you know they have a trajectory of growth. And if it's a loss, you just know they're going to pick again. Don't go for these companies that are going to give you dividends of 20%. What are they reinvesting? So that's actually a red flag at the end of the day. So there's so many things to look into it, but it's a good and viable idea of actually diversifying your investments.
So I want us to dwell there for a minute, because around the topic of shares and stocks, we're also finding other stories like day trading and all those things. So what exactly are those? Because everyone, when you wake up in the morning, they want to be a trader. What are those exactly?
There's a difference between trading and there's a difference between stocks. We have different aspects of investments, and some of the I know the investments which are like funds, like the special funds, which you're going to find they will take your money and then they will diversify, and they will decide as now the what they call maybe brokers, or what they call the fund managers. They will decide to invest in stocks, in the international market, in the commodities, and all those things. But if you're talking about stocks in the Nairobi stock market or exchange, there's no in-betweens of this or trading or this. It's either you're buying Safaricom, you're buying Equity, you're buying this particular company. The rest of the things, because there's also a lot of scamming with this era of like financial literacy. There's a lot of things that are happening there. And I know your question is just coming from maybe forex trading, maybe cryptocurrency, maybe you see kwanza those digital trading and such things. I know that's what is like the whole point to discuss. But one thing I want people to understand, I'm not saying that those investments are not investments in real sense, but those investments have been capitalized by so many people because there are no basic structures. Remember, if you're doing forex trading, this is like a general market. This is a digital coin, currencies. We are trading in currencies. And this means like it's not like an entity for anyone. There's no one who owns Bitcoin. There's no one who owns Ethereum or any cryptocurrency or digital coins. So there's a lot of scamming that comes through that, because for you to understand that, it might need you to go and do the basics. But I always say this is for the big boys to have fun with.
Very profound.
Invest money that you can lose. If you're a person who has 1 million and if you invest in forex, you're going to sleep in a nice view somewhere. Don't. You just go to the other safer investments, I mean, because I know people who actually do these investments, and even international market, they do international stocks and such, and they are making a lot of money into it, but they're also losing a lot of money into it. So it's a game of numbers. It's a risk-taking venture. So you need to make sure that you invest money that you can lose, and you also need to understand, do your due diligence. If you choose a broker, what are they charging? What are the management fee? What are they investing in really? What is my risk? Can I take the risk? And then you can choose. But in the Kenyan market, mostly kwanza around forex trading. Let's continue.
It's a risky affair. So now, when we talk about investing, it's one way of shielding yourself against inflation.
Yes.
I might say it because I understand it that way. But there is someone who doesn't know what inflation is. Kile kitu najua inapulizikanga ni balloon tu. So explain to us, what exactly is inflation? We wake up today, the value of the Kenyan shilling is at 100 towards $1. Tomorrow it's at 120. We don't get that. What exactly is inflation?
So inflation is when the purchasing power change. So like, for example, just a simple explanation, if I have 100,000 10 years ago, I would comfortably be able to buy a piece of land somewhere.
Yes.
But with the same 100,000 right now, you cannot get a piece of land somewhere.
Someone's rent.
That's actually someone's rent. 100, it's not a lot of money. I mean, it's just more like the purchasing power. So meaning whatever amount of money, whatever you'd be able to purchase with a certain amount of money 3 years or 2 years ago, before COVID, after COVID, it's different from now. And this happens because there's a lot of developments that comes in place, and there's a lot of money circulation, improvement around maybe the countries and the economic structure. So everything is just going into basis of, now we have more people who are making millions. We have more people we know billionaires. You basically right now know this is a billionaire. 10 years ago or 20 years ago, there was no billionaire. They were millionaires, you know. So there are so many people who are touching that side of wealth, and this now make it now small money to get. It's a small margin to get, and this now increase the purchasing power. So this is what is changing in the dynamics of economics, and now that's what basically inflation is. Like whatever you would be able to buy with 1,000 last year is not what you would be able to purchase right now. So when you invest, why now investing is the only way to shield your money from now the inflation? It's because if I invested 1,000 3 years down the line today, I will not have 1,000. It will be maybe 1,100. So if maybe whatever I would be able to buy then with 1,000, I can be able to actually afford now with the rate that I have gotten or the interest.
I've seen some countries, where we have a note for 10 million. And they say it was affected by inflation and all that. Does the law of demand and supply also play part in inflation?
Yes, it does. So the whole balance, and that's why you see when we have a lot of money laundering cases or scamming, the economy becomes just somehow hard. You just feel there's some pressure that comes in.
Yes.
So in some of these countries, they continue printing the money.
Okay.
So you'll find like all of us here, the 10 of us here, we have 1 million in our pockets. So that means we can be able to afford whatever 1 million would offer.
Yes.
And that means that we are not, the supply is not able to actually maybe support the demand, and that makes our money useless at that particular point. So that's why now when it comes to printing more money, you have to look at your capacity as a country. And this is why now the whole ideology around now the wash and such things, there have to be a limitation to just avoid so many people, so crowding of people having a lot of money or having to hold a lot of money, because that can get our country into that place where now money doesn't have the value because we all have it.
Is there a mathematically viable formula of reversing inflation?
Yes, there is. So what we use as a standard or what we'd call a calculator around inflation and reversing it is like currently the inflation is at 4.3%. So meaning if I'm able to get a return on investment on any investment, double that amount of money in the next even 1 or 2, 3, 4 years, I can be able to have been able to make sure that my money is still the same value as it was when I was investing that money. So the Central Bank of Kenya usually offer like an overview, and they usually give us like the inflation rate or the inflation base rate, and then you can be able to calculate against that. So if you get into an investment giving you less than 4.3% right now, that means your money is not beating anything. But if you get double that amount of money, we always say if you can be able to get double that amount of money, that means even in a span of, if it's a fixed fund, even in a span of 5-10 years, your money will still be having the same purchasing power.
So now there is that investing in an investment that will give you double the rate of inflation. But is there a way of, let's say it is 4.3 or point something. Is there a way of lowering it down to 4 flat or 3 point something, the rate of inflation itself?
Oh, okay. Yes, there is. If we can be able to do more of like economic activities. So remember when we have like a stable country, that means that there's money circulation from the top down to the bottom. This means that we are empowering more people to be able to achieve and get things. So this means if in a country, let's assume in a country we have like 100,000 people, and maybe let's say 10% of the people are driving, or 10% of people are asset holders. That means that economy is doing well. But when we are retaining more money at the top there, and there's no money circulating and coming down, now that's when the inflation will continue being high, because there's less supply of the resources, and the rich are the rich, the poor are the poor. So there's not so much of the economic activities that are happening. So when it comes to growing an economy and beating the inflation and making your currency is stronger, it's to just make sure that we are having economic activities. So we are having so many other people coming in place, making new money, making new billionaires, making new millionaires, like just circulating and making sure we have ideas around that. This now is going to reduce the inflation rate. Remember, when the inflation is high, this comes even to the basis of borrowing. Because at that particular point, most people cannot be able to afford the basics. So we need loan to survive. So if we are borrowing so many people, the bank is going to increase on the base rate or the base lending rate. So for economy to be at least standard, it's just make sure that there are economic activities, and the money is
trickling down.
It's not going there. I would have used that word, but it's not. It's not going down only. It's just actually getting to circulating. That's the only way to just reduce that. That's now going to give us the basis of we can be able to live within our means as a country, and we can be able to not be able to depend so much on other loans which come from outside, from development or something close to that. Yeah. So that's the basics of it. But as a country, with the corruption, you know how that goes.
Actually, you've said something very profound there, because when it comes to corruption, many corrupt people are hoarders. They accumulate and hold wealth. If you're accumulating it and making it circulate, at least we won't feel the pain of the economy tanking. Back to personal financing. I have gone through the stages of investing. Now my money is secure. It's paying me a good interest and all that. So what next? Because now I'm getting 8% or 10%, or in money market funds, I'm give 10%, 14%. And this return is good. Now, what next?
Okay, so there are different levels into the financial freedom. And one of the things that I want all of us to understand is it's a journey. So it's never a destination. Meaning now, today, you're excited about 8% in a money market fund, which is maybe you have invested 10 million. So that's giving you 800,000. And that you're like, I know I can pay my rent, my bills from my money market fund. But now there's levels to this. Today, you want this particular lifestyle. Tomorrow, luxury is not the same thing.
Okay.
So there's no particular point, or I have ever gotten a client who feels like, now I'm okay. I don't want more money. It's always more money, because if I get more money, I'll be able to get maybe that car that I have always wanted, that mansion that I have. If you have the mansion, you actually want another mansion in different locations. If you have this certain lifestyle, you want it to be more. If you travel once in a year, you want to do 2 in a year. So I don't think there's any person who will ever get to a point, now I have set my investment, I'm okay. No, we are just created to want more. We are just created to just want to get better in life, because there's no edge to this unless you get to the financial independency. So that is mostly now the who's and who's. These are the billionaires, and they have money, and they do now that for class. That's where you find the hobbies they are borrowing will actually shock you. You're like, why would you want to go to space? Why would you want to go to Titanic? Why is that even something that...
thing.
Yeah, because for them now, they develop interest away and above something we might understand as basic on our 5th level, middle class, or something close to that. So I feel there are levels into it, and at each and every level, there's always something, a desire that you'll have as a person. But the whole point is never stop investing. Continual investing. There's no point you'll get to a point now you're not investing. Even at retirement, you want your money to be giving you a return on investment, so you're still investing. Even at retirement, you want your portfolio to be making sure that this money is giving me more money so that I can live a generational wealth. So it's just a journey that never stops, but the whole point is to make sure that you're satisfied at each level, because I think that's what most people don't have, the contentment. It's not a journey of looking for more money. As you hear me talk, I'm not talking about looking for more income. It's not about today you're earning 50, let's look for 100. It's not a game of increasing your income. It's more of like, what would this reflect on the other end? If I did this decision around my money, if I took this investment, what would that give me? So in each and every stage of your financial freedom journey, make sure you have the contentment. Make sure you're doing the maximum that income can actually give you.
So how do I safeguard my wealth?
So there are so many ways of safeguarding your wealth. One, by transferring the risk. So if you have your wealth in place, make sure that you are a person who understands that you might need a protection portfolio. This is where insurance comes in place. So if you have assets, insure them. So that in case of anything, in case of a lawsuit, in case of what? There's insurance for everything to make sure that your wealth will never go down. That's the first thing. Make sure that you have a protection portfolio. Get insurance for anything that is available on this world. Make sure that your wealth is well protected. Around everything, there are so many insurance products that are there. The second thing is working with experts. one thing I will say here is also as a financial advisor, I have a financial advisor because I can never know everything. It's easy to manage other people's wealth, but it's very hard to actually develop my financial habits.
Very true.
Very hard. So you will need wealth managers, you will need accountants to make sure you can evade tax here and there, or your tax is filed. You don't find yourself in a place where you have to deal with tax and such things. You have financial advisors to make sure that they're telling you this investment is going down. Can we look at this particular other investment? So the basics is have the insurance, transfer the risk. The other one, work with experts. That is going to make sure that it's just a journey of it. And then pre and post. Because I know there's protecting my wealth right now, but how do I make sure that my wealth reach to my generation the way it's supposed to? So the post, when you're not maybe even there. So this is where now you transfer that, or you hire trustees, have a trust fund, have an estate plan, write a will, have people who can be able to manage this money, and they understand you as an entity and how you would want your wealth to be distributed to your generation. And the best of it, post is make sure that you educate those people you want this wealth to get to. Let them learn about the basics, ideas around finances, so that you don't want your wealth to be blown just like that. So it's the pre and the post, but those are the options that you actually have.
So now, you've mentioned the insurance, and there is a very common rumor in the industry that the golden rule of insurance is to never pay out. Like I've said, it's a rumor because personally I can't confirm neither deny.
Yeah.
Because it is out of experience that you can approve something.
Yeah, true.
From a wealth or financial advisor's perspective, how has your experience with insurance been?
So first of all, the basic rule is actually never accept a claim. Never accept a claim until it's proven it's a claim. Because one of the things insurance companies are in business, they're not there for just some charity or something close to that. But one of the things that I want Kenyans to understand is their terms and conditions in each and every product, in each and everything that you want to do in this life. There are terms and conditions. So yours is to make sure that if I have a medical insurance, I know what is the waiting period. I give the correct information around it. You don't go around lying, I don't have any critical illness, and then 2 years down the line, you're not even diagnosed with cancer. It's stage 5 and you knew, I don't know if there's stage 5 actually. So the basics is to make sure that you understand the terms and conditions. The second thing is to make sure you don't lie. Give the information as it is. Even if they're going to charge you an extra amount of money for your car, which was damaged and the bumper imeshona huko ndani or something close to that. Because I know people manipulate the system to that level. So just, if you do it right the first time, even when it comes to the claim process, it's going to be right. But if you do it wrong, just know, if you're found, you're going to be an example. But one thing, insurance are regulated by Insurance Regulatory Authority. So if your claim is not paid, you need to go to report to the regulator, and that means that they can be sued. And you don't even have to be the one who sue them. You'll have some representation, and if the matter is there at hand, you're supposed to be paid. And with the rise of information, we have reviews. You can be able, because some of these things, it's not even the product.
Yes.
It's not the medical insurance that has a problem. It's not the car insurance. It's not the domestic package. It's the company. So there are companies that are known for certain kind of a structure or misconduct. So if you can be able to get that information and get the reviews, do your due diligence and make sure that you're choosing the right company. But the whole point about insurance, the terms and conditions, follow them to the letter. You're going to live a happy person. Like myself, I have used a health insurance since 2019, 2019, before even COVID. And I have heard that I have a car, I have a comprehensive, I have done some few accidents and they have fixed my car. So I have seen people paid claims and such things. I think the insurance will not allow fraud and also people who lie. Don't lie in the insurance. So
now, when it comes to insurance, for the sake of information, Let's say you buy a car, you have it under comprehensive like yours, and you never have an accident whatsoever. So what happens to your principal?
The premium is not paid back.
Uh-huh.
Yeah, so insurance is like taking it's a protection of a risk. It's like if it happens, they are going to repair. If it doesn't happen, which we wish, because insurance doesn't cover on happy situations. They are covering on the sad situation, because if you will have to use your medical insurance, you're sick. If you exhaust your medical insurance, which is 2 million, do you imagine a health situation where you have to do 2 million? It's very hard even on your end. So if it happens, you don't get into a financial constraint as a person to repair your car, to pay your medical bills or something. If it doesn't happen, well and good. This is an amount of money I set comfortably from my budget. So I can afford. So even if I don't get to use that amount, maybe someone else used it. And if I get to use it, sorry to me, but I don't have to suffer the financial hiccup.
Awesome. It's good to clarify that, because there are some people who, especially if you're new to something, I mean, money, at times it's painful to spend on anything, especially for, you're getting your first money, you do tamiyaga, then you have to pay insurance, it's your first car, then you'll never get your money back. That kind of a situation or conversation is sometimes hard. So it's very good to clarify what exactly happens to your principal in such a nini. You've mentioned about a trust fund. There's some people we've seen flaunting wealth and all that. Then there are some others in a corner saying, those are trust fund babies. Let them watatupata pale mbele. So I wouldn't be one to say that, because I don't know how someone was raised. Maybe they have earned their money genuinely. Doesn't matter who their father was. Maybe they work hard and all that. So what is a trust fund?
So a trust fund is like a cup that holds all your wealth and make sure that your wealth is well distributed to your next of kin without having to go through the law or what we call a probate. So it's more like hiring trustees or hiring people or contracting people who are going to make sure that your wealth is distributed the way you wanted it to be distributed, even if you will not be there. So mostly a trust fund is more like a way of passing down wealth. And then we have like two categories of that. So we have an estate plan. An estate plan is like basically where they will manage everything that you own. So if you have real estate, you have apartments, you have, for example, you have investments out there, everything that you have, and then you're going to write how you want that to be distributed into your next of kins. And then they give you the basics of even writing, at what point do they get this, at what point they, like even the age and everything else. So the whole idea is to make sure that your money is held in one place. Also, like you get an advantage of these trustees have wealth managers and wealth advisors. So they get to advise you where to put this money. So your money is also like growing in terms of interest, and they make sure that your wealth is actually being managed in the right way. And it's equally important. I know most people in Kenya, they do the bare minimum of a will or a word of mouth. Most of us is a word of mouth. Hii shamba ni ya nani, hii ni ya nani. Some people do wills, but now a trust fund bypass the whole probate process. So in case of demise, the wealth will be distributed the way I wanted as a person, and there is no in between of this was a son. If you're not there, you're not there. So there's no like the whole process. So that's more of like a trust fund. And then the cash fund is more like you can be able to choose investments within that trust fund. So you're going to find trust funds are offered by insurance companies or insurance investment, mostly insurance company, not even investment. So they have like a group, like they have maybe a trust investment company. And then now what they usually have in the cash value, they give you like products you can be able to purchase in that trust fund. So like maybe you buy a money market, but now have it under the trust fund. And you can be able to set this with as low as 5,000. This is our dosi sana. You can be able to do this. And because if you're conflicted in between you have your kids, but you don't trust anyone, get a trust fund. And even if you have people who you trust, but you're like, they might get a boyfriend or they might get a girlfriend and spend all my money, get a trust fund. Your wealth will be distributed the way you want. So when you hear of a trust fund, babies, it's a person or a parent sat down and decided, my son is going to have 10 million when they're 29 and from this investment. So that's what it means to be a trust fund baby. So it's the easiest way of passing generational wealth to your kids.
Can a trust fund have the capability of investing by itself as an entity?
Yes. So the cash fund gives you that. So it gives you an opportunity where they offer investment instruments inside the trust fund. So you're able to choose the category. Like what I said, you like have an education fund in a trust fund, you have a money market fund in a trust fund, you have a bond fund in a trust fund. There are investments that are under a trust fund. So that's the cash fund. But on the other end of the estate, you can only bring in what you have already accumulated out there. And then now it's managed.
That's very profound.
We should be trust fund babies. So our baby should be.
Our baby should be. We will not question what our fathers were doing.
You're going to make the difference. I know
going to make the difference. I think maybe we could. I believe they didn't have the information like we have right now.
Yeah, true.
By the way, the next course of action in any context is determined by the information that you have. So at times we are harsh on people and the only thing they don't have is information. Actually, if they had information, they could have done things better than we are doing.
True.
So now, when it comes to personal finance and personal wealth and all that, what are the things that you're supposed to look out when you're onboarding a wealth advisor?
The first thing is the right credentials. You need to see if they are licensed. So in the country currently, you either get a person who is licensed under the Capital Market Authority through maybe an investment company, like maybe Standard Investment Bank, or maybe under an insurance company. So that's the regulator is ARA, so their certification will be around that. The second thing and the most important thing is to just make sure that you're in psych with that wealth advisor. Because you also don't want a person you're telling, I want to go to Dubai twice a year, and they're like, no, buy a piece of land.
Yeah.
You need to understand the basics of like what they understand or what they have seen in life and how open-minded are they, and can they be able to hold my goals? Can they be able to hold my future, or can they be able to hold that vision that I have to that place? So that is quite important, because I get so many people who are frustrated by advisors because their advisor maybe has some mindset that is not resonating with this kind of a client. So you also need to look at that. And then I think the last thing is just to look at their portfolio. Most of the wealth advisors and the financial advisors, they have the products that maybe they are pushing out there. Most of us have a product. We have partners we have partnered with. We have companies that you're working with. So you need to understand what is in their portfolio. What are they offering? What are you bringing to the table at the end of the day? Is that what I'm looking at? Is that the portfolio? Because I have found also like people who will come to me, in my portfolio, I don't have those cryptocurrency, forex trading and such things. And then they feel like I'm a less financial advisor. Or I don't. It's because you did not look in my portfolio. I don't have that already. But there's another wealth advisor or financial advisor who capitalizes on only that. They don't even have other investment, like maybe moderate investments. So you also need to look at the solutions that they're giving you and then see, is it resonating with me as a person, my financial goals, the solutions that I'm looking, and then now it's easy to choose from that point.
So what I'm getting from you, the work of a financial advisor is to help you achieve the goals that you have set, and not necessarily to tell you how you should spend your money. Because now that's what I'm seeing online with so-and-so financial advisors. You've seen them, they're making a lot of noise and all that, trying to tell us the way we are spending our money is the wrong way. And they didn't take time to even understand whether those were the goals that we had, or whether we were working with a financial advisor who actually got us to that point. And actually, now it brings me to this point of Why do you think some people, when they brand themselves financial advisors, they are so opinionated on how some people spend their money?
Because some of us are trying to push a product.
Okay, yes.
I'm trying to sell you a money market fund, so I don't want you to think
Of anything
about
else.
shares.
You
know, I'm trying to sell you a fixed account. I don't want you to think about bonds. Bro, you cannot. Because that's where I'm getting the commission in. So at the end of the day, as a financial advisor, I also have an income that I want to raise and come up with.
Yes.
So if I'm not charging you a consultation fee, I'm either selling you a product. And if I'm selling you a product, now that's now the whole point of need analysis. And this is I think, as financial advisors, this is something that most of us struggle with. I think for me, I've outgrown that stage because I have really gotten the exposure. But in the initial stages,
Yes.
it has to be very... If it's not this, it's this way, you know. But now, over time, you just realize that we are different. We have different goals. We have different beliefs. Everything we define is different. Your way of defining soft life is different from mine. I'll be like, that's for fun, you know. So it's quite different for everyone. So as financial advice, I think our highest thing to do right now in the market is just to make sure that we understand our clients first, do the need analysis first, understand who is this client, what are they looking to achieve, so that you don't tell them don't buy another piece of land and they grew up in a slum somewhere. So you're getting them in a very traumatic experience, telling them that they should not, they have not seen someone own a piece of land. Rather, help them own the first piece of land, but don't get the second one. The second one, get another investment. I think it's more like do a need analysis as a financial advisor. And if your financial advisor did not do a need analysis, they just told you, take this, there must be a very long-term problem coming. Yeah, because you might not understand each other. What are your grounds, what you want, and what you're looking for. So for me, I make sure I understand each and every client so that before I payuka and I tell you need an education fund, and then the person is looking at you, I don't want to get married, I'm child free. You'll be like, it's not a conversation to have at that particular point. So also understanding your client is something that we are trying to be trained and learn over time. But I think this is something new that we have seen. It's just something new, but I know the market will streamline and we can be able to get the information the right way.
Awesome. Now, you've said there are certifications. What are those certifications, or are there bodies that regulate the inflow of financial advisors?
Okay. So at the entry level, most people will start as insurance agents, who are now known as financial advisors, because now insurance companies have now incorporated all the companies to investments and such places. So you automatically licensed under insurance regulatory authority. So most of them, if you did not do insurance in school, you're going to do it at that particular point. But in classes of a person like me, I did finance in school. So like some of my partners, I work with an investment bank as one of my partners. They only needed to see my credential around the same. And I'm also a CPA 4. So that's also gives you some routing when they're giving you the license. So that one gave me now the Capital Market Authority licensing and the Retirement Benefit Authority licensing. So those are the basics of that. So if your partner on board you and they already have a license at its level, you're automatically licensed. But in the basic entry, mostly in insurance, you'll get to be trained. There are so many masterclass that are out there that people do, and some which are recognized by now the institutions at large. Like there's a masterclass by Wahomengare. He trains financial advisors on how to do such things. But now in advanced level, you might need to do maybe a chartered or a certificate at that particular point. So we have like the chartered financial planner, chartered financial analyst. But the basics entry, if you have maybe a finance degree and maybe you're working with a company that offer financial solutions, you can get the license very easily. But now in advance, like what I'm looking at is I really want to get that CFA. It's actually CFA, it's very expensive, and it's also like complex, because now you're talking about global market. It's not just local market. But these days we have just people who are self-taught. You just wake up, learn about money market, and open a YouTube channel. Then now everything you talk about is money market fund. You just mastered it. You go invest in bonds, understand bonds, and then you start doing bonds. But I think it's just something that is going to come in place. Some advanced countries like South Africa, they have a body that actually license them. But in Kenya, we don't actually have a body like now, a body that looks at the quality, the qualifications, and all that. But we are hoping that maybe in coming days, we'll have maybe a body that regulates all that.
Awesome. Now, those are regulations and all that. I've also seen accolades in your social media platforms, in your YouTube channel. If you don't mind, you can share with us. I've seen trophies. Are they for specific areas, or what are those? Yeah,
they're for specific areas. So as I said, most of us start as insurance agent. So, and as always, I always say, once an insurance agent, always an insurance agent. Because once you just realize or get a client to get products in an insurance company, most of them are long term, so you have to be stuck with them for the next 20 years or 15. And it's also interesting to just see the way you help people with their discipline. So that is a recognition by one of my partners, ICA Lion Group. So this means that I was able to onboard a certain category of clientele. So I'm recognized first of all by Insurance Regulatory Authority, so I have a certificate on that. And then I'll have the company, because I was representing the company, or I sold those products. So as I always indicate, I have like products that I offer, or what is in my portfolio, the solutions that are going to give you there. So now one of them was now the insurance and those savings account, and now 4 years into it. 4 years into it, wow, we have always gotten the award.
Wow, 4 years in a row.
It's 4 years. I have 4 awards.
Wow.
I should have carried them.
You should have carried them, because I saw them in your YouTube channel and I was like, okay, you're dealing with a real guru here. Congratulations.
Thank you.
You know, we must give credit where it's due.
Thank you.
And recognition doesn't just happen. You just don't wake up and get recognized. It means you put in the work, the company recognized you, and also the market recognized you. So congratulations for that. There's a question that has been posed on how to manage your money, especially on 2 instances. A person who has a job, a 9 to 5, and a person who is freelancing.
Okay, so first of all, if the dynamics are almost the same, but not the same, but I'm going to mention why I think you should use a streamlined way of doing things. Because I know when you're talking about managing money, how do I budget? That's the first thing. How much goes to my expenses? How much goes to my savings and investment? So it's easy for those people who are employed, because I know it's 100,000, 50,000, it's 20,000. And if there is an increment, I can be able to budget on that. So mostly it's so easy for those people who are getting a constant income stream, or what we call like a predetermined. You already know, or you're sure about it, because you can use any rule. You can use the 50-30-20 rule. 50 needs, 50% goes to needs, 30% goes to wants, and then 20% goes to savings and investment. But now the actual work is on the freelancers and the business people. And I think this is a whole lot of conversation, because one of the things is I really want to understand, or maybe I can just start from the basics and then maybe a challenge what most people do. I feel like if you're a freelancer or if you're a business person, you need to have your bare minimum. This is the bare minimum. This is the target to my business. This is the target as a freelancer. And some of the ways of being able to know how much you might set as your basics is your basic expenses. If your business is your sole source of income, it needs to pay your rent. It needs to make sure that you save, you invest, you take yourself out, you get a good haircut, grooming and everything else. So if maybe in a month, I need 30,000 to survive, and maybe need to save 10,000. That means me as a business owner, I need 30,000. So if I'm running a business online, I might need to do Wi-Fi, to do marketing. I might need maybe if it's maybe where you need transport, riders or something close to that. If in total, my operating costs plus the amount of money that I need to pay myself as a business owner comes to 100,000.
Yes.
That is your target for your business every month. Okay. And most people don't have that because you're like, sometimes I earn $500,000, but I want you to do an analysis. Since you started running that business and becoming a freelancer, how much money you have made for 12 months.
Yes.
Divide that by 12. You'll find most people are even earning around, I mean a return on investment, not the operation cost. I mean the return on investment after everything. You'll find most people earning 30,000.
Yes.
And then I'll sit down and ask myself, but why should you not be employed and earn 50
Yes.
or 100? You know? So if you set the right structures in your business as a freelancer or even as a business entity, you're going to be able to budget as a normal person who earns a certain income, because I believe that if 100,000 is coming in, I know how much will go to my business and how much I'm paying myself. So whatever I'm paying myself on personal finance basis, I'll be able to budget 5,000, 2,000, 3,000 goes to this and this. So there's no room to say, as a business person, you cannot save. As a business person, you don't need a retirement fund. As a business person, you cannot do this and this and this.
Yes.
Those are the things that are going to scale your business. Because if today 100,000 per month business target or a freelancing target is going to give me this lifestyle, but I want to live in Kilimani.
Yeah.
It means now the target will go to 200 so that you live in Kilimani. If in a year you're making a return on investment 30,000, and in whatever you do, if you went to corporate, you can be paid more. The whole goal is actually the money. It's not the legacy. Not everyone is a person to build.
Yes.
Because I think we have glorified the whole idea of freelancing and business to a point we forget the whole aspect around it.
Very true. Actually, hapo uko karibu kukuza mlima. Kwa sababu actually we wanted to actually demystify that notion. Not everyone is a builder. Not everyone is interested with owning companies and owning businesses and having title CEO in their nini. Someone just wants a consistent form of income where they can invest and reinvest, then compound interest, and they'll be okay kulingana na goals zao. So at times some of us gurus in the online space are shoveling ideas down people's throats on how 9 to 5 is bad. You should quit. Not everyone wants to quit.
Yeah, please.
Not everyone wants to quit. And if people have to quit, then enroll into your, I don't know, whatever that you're selling, so that you can show them a way of surviving now outside. Please, not everyone wants to pursue that route.
Exactly.
And you have to respect people's
opinions. And I think it's also that the way we put the 9 to 5 is a problem. We need to call out some people.
Yes.
Some people need to stop running those businesses and go look for a job.
Yes.
Some people are just rotating. You just, in a whole year.
Yes.
How do you explain to us in a whole year you made 120,000 and you have 24,000 followers on Instagram selling thrift? I mean, that's 10,000 income.
Yeah.
Go look for a job.
There is something that you have actually said when, when you do those calculations, then take your profit, then divide it by 12 months. Then you find... Oh my goodness, have mercy on us. Because most of us, the people who are in employment are way better
than us.
Yes.
And it should not be that way.
Yeah.
I think we have, if you're creating, if you're a person who is creating or a business owner, a CEO as you are, I mean, we are the people who should be touching that level of wealth, where they say that that paycheck is not going to give you wealth.
Yes.
If you're not getting that, it means you're supposed to be in an office somewhere 8 to 5, come back, sleep.
Yes.
I mean...
Now you need do your expenses, minus fare, minus lunch.
Save kidogo, invest kidogo.
Yes. And leave this other pressure alone.
Achana na mambo mingi.
Because we are out here pressuring people. And really we are doing hand to mouth ourselves.
True. A very sad situation.
It's tough. It's painful. It's personal. but
Don't cancel me, guys.
But it's
Don't
reality. I
cancel
mean, it's
me,
reality.
guys.
It's reality. It's reality. And I mean, if you want to change the narrative, you must begin with the truth.
Very true.
You have to start with the truth. You can't sugarcoat things. Then all of a sudden, wewe ni kodo imevaa nini? Ni mbwa mwitu aliyevaa ngozi ya kondo. Right. Actually misleading people. And it's quite sad.
Very sad.
So if you're out there and if you want to pursue the journey of creating wealth, you can start with anything that you have.
Yes.
Be it your job, be it employment, or be it that hustle that you have.
Yes.
Self-employment and entrepreneurship is not the only way out.
Yes, it's not the only way out.
We have CEOs who are making 30 million every month.
Yeah.
And they're in employment. They're employed. So if we are to demonize employment, si hata tuguze hao pia.
Tuende hao.
Yes. Tusiguze tu wenye ni middle class, wenye watafeel pressure.
50, 100. I mean, let me tell you, there are companies which are paying people well.
Yes.
There are people who are getting well. I sit down with clients and I'm like, I want to work for your company. Why do you have even some even advantages that these people get? Like you find someone has an income, like they after tax, they're being paid 520,000
after tax.
Yeah, and their work experience is around 7 years.
Yes.
And then you find that they have a medical insurance, 4 million inpatient.
Yes.
And you're like, guy,
Yeah.
100,000 outpatient, and then they have a pension. They contribute like the 52, they contribute 10%, 52,000.
Yes.
The employer match 52. So 100 G's is going to, my friend, how are you going to tell me that 9 to 5 will not give that guy wealth if their money can be able to be managed well and they invest well? I mean, we should just agree that the whole point or the goal is to have the money, manage it well, invest, get the wealth. So where the money comes from should not be a question.
I think to tie it up together, I would say this. Since we are not heading to the same direction, we are not expected to use the same vehicle.
True.
So let everyone use their form of investing, and the best way they know how to. Let them look for their financial advisors who can start by telling them the truth.
Yeah.
And if you're a financial advisor out there, there are many ways of killing a rat. Just don't burn your house, because you'll also sleep outside.
True.
Yeah. So how can people book you? You can give out your social media platforms, your office line if you have one, or the number that is there in the public domain.
Okay, so you can follow me on all the platforms as Jane, the financial advisor, or just Jane Ndichu, everywhere: LinkedIn, TikTok, Instagram, Facebook. I'm not big on Facebook, but you can follow me there. And YouTube, I have a YouTube channel. And also, if you would want to talk to me directly, you can maybe WhatsApp or call me on 0702 531 073.
Very nice. So right now, after having that whole load of financial wealth knowledge, also knowledge is wealth, because out of knowing that you get to take action.
True.
Those of you that will take action, go take action. Personally, I will take an action, and my babies will be trust fund babies.
Yes, please.
Yeah, they would say that their father was a tycoon. Alijipanga. They will have an estate. That's the EE PowerTalk episode 103. I've been your host, Daddy Blessing. See you in the next one.